Today, we'll take a look at proof that ETFs, not TikTok traders, not crypto Twitter, and not Reddit hype, are the driving factors of this crypto cycle. I'll show you the data, the charts, and why this is the single factor that is currently rewriting the rules of crypto forever. First off, what are ETFs? You can think of them basically like an institutional on-ramp to crypto. They need this because they are held back by policy and fiduciary duty to manage capital in specific ways. These ETFs open up floodgates of capital from pensions, endowments, and hedge funds. These ETFs also funnel all of that capital directly into Bitcoin, Ethereum, and the general crypto ecosystem. But one thing we must understand, this is not retail flow. This is structured, this is engineered, and this is clinically directed into the market at specific pricing. ETFs are basically something that connects the broker, institutions, pensions, perhaps even maybe a 401k, a retirement fund, to the ETF, to then Bitcoin. Back in January 2024, the first official US spot ETF was approved, and I believe it was the IBIT ETF from BlackRock. No surprise there. On the right, we have crypto in its previous bear market. We saw the first structural wave of liquidity come in, and then the ETF got approved. What happened? Bitcoin ran from 30K up to 73,000, breaking all-time highs and then proceeding to consolidate as institutions accumulated for 7 months. Previously, I had mentioned that the capital flows coming from ETFs come in a more structured fashion compared to previous crypto cycles. Here I have the 2017 cycle, and then the last cycle, I believe it was up until 2020. So what we can see from both of these cycles was that it was pretty much a straight move up. We can discount the last cycle a little bit just because there was a degree of institutional involvement, and we had that fake out in the middle of the cycle, and it was also subdued due to COVID. However, in the earlier legs, number went up versus this previous slide where we can see there is clear structural segmentation in the market. I call that modular structures, and that is part of my modular structure thesis. We can clearly see here on this chart, it's Bitcoin daily chart lined up with the IBIT BlackRock ETF. What does it tell us? Well, it tells us that institutions now manage Bitcoin's price action. It is no longer retail in control of these markets, guys. It is institutions, and they move in modular waves. On the left, on Bitcoin, I've highlighted 3 of these modules so far, and we are currently encroaching on our 4th one and eventually leading to the final 5th wave that will play out sometime in the near future. We need to understand, guys, institutions carry billions and trillions of dollars of capital. And so far, all of these ETFs have accumulated roughly over 6.5% of the total supply of Bitcoin. So what can we take away from this? We now know that ETFs control the flow of capital in and out of Bitcoin for the most part, disregarding the Michael Saylors, and we can talk about the sovereigns in another video. But for now, institutions are on-ramped through these ETFs, pension funds, endowments, big capital is coming through these ETFs, and big capital takes control away from retail. Another side quest subsection of this idea that wrappers are now in control is the deepening of the Bitcoin credit layer. Now, I have this overarching thesis that spun out from my research fund, Palfrey Limited, where we've been tracking Bitcoin's transition from a commodity to a money. What this means is the credit layer is a key component of that transition. And these ETF wrappers have allowed institutions and these massive funds to come into the space and begin taking Bitcoin from up here and pulling it deeper and deeper down into the system's credit layer. I have a few charts I just want to show you guys before we wrap it up. These are some placebo well-depth index charts that my fund has spun off for this video. And essentially, it takes 7 key metrics of Bitcoin and its tokenomics and distills them into this index. So what this index shows us is the depth at which Bitcoin is being pulled down into the credit layer. So on the left, we have a scenario where Bitcoin isn't used much for credit, right? Why? Because retail has very thin capital and institutions didn't have these wrappers to onboard themselves. On the right, we have the most giga bull case where Bitcoin gets pulled all the way down to the base layer and is used as the base credit, premium, pristine collateral for the entire system, both DeFi and legacy. And finally, this was a real-time chart we're going to publish this week. I'm giving you guys a sneak peek. This is the current WDI reading for us. And at the bottom, it's displayed in a single score. So anything below 0.6 is a modest rating. Anything below 0.3 is a very low rating. And then anything above the 6 is considered Bitcoin being adopted and pulled farther and farther down into the credit layer. We can expect with the expansion and the success of these ETF wrappers that Bitcoin will continue to be used as base collateral. And we can expect the impact on Bitcoin's price to be that of a very positive manner. This is a very positive thing for Bitcoin, guys, okay? It is a crucial step in this overarching thesis that I've been developing. Bitcoin going from a commodity cycle to a money cycle. And these wrappers are the crucial part of it. If you guys aren't subscribed to the Substack, go check it out in the link below. I post a lot more of these models from my fund. So go check it out. Drop a comment if you guys enjoyed this video. Leave a like as well. Hit that subscribe button. That would be greatly appreciated. I'm trying to build an audience here. I'm trying to help educate you guys on finance, on this weird and growing ecosystem that is crypto, and hopefully help you guys navigate into the future. Anyway, it's been Chris from Coin and Capital, and I'll see you guys in the next video.